We believe that AI is a very powerful tool that should be put between the hands of the humans, between the hands of the human asset manager or the human investment committee or the human CIO. Why? Because at the end of the day, it's so much of accountability. You do not want, as a bank or as asset manager or as a wealth advisor, to come one day to your client and tell him, listen, your performance was great or was poor because of AI decision. Using AI for automation, to accelerate the tailor making of the portfolios is good, provided that it stays within boundaries that are fixed by the investment committee, that's fixed by human beings. You should hold yourself accountable in front of any clients for any weight that the AI could choose within these boundaries. With the AI, we have somehow reached the level where in a few seconds you can get your tailor-made portfolio.
I want to welcome you to the second season of Couchonomics with Arjun. Join us this season as we go beyond fintech and payments and embark on the journey into the future of financial services, a future which will be shaped by existing and new developments in technology and innovation, including and not limited to the likes of embedded finance, open banking, ESG, various versions of metaverse, decentralized finance, digital currencies, and other trends. On the couch, we're going to have the most influential and progressive-minded founders, executives, investors, regulators, innovators, and industry commentators from across the MENA region and beyond. Join us as we unravel a multitude of layers of the financial services industry and try to learn how technology will continue to impact the world that we live in. Couchonomics with Arjun is proud to collaborate with some of the most respected and innovative names in the world of payments, fintech, and technology. Ardian is a reliable end-to-end payment solution that provides innovation and flexibility to help businesses achieve their ambition faster by turning payments into a strategic growth driver. Get everything you need with 2U, a Saudi-based super app for delivery, mobility, on-demand services, and a lot more. 2U connects you to everything you need to enrich your daily lives by building an ecosystem across its end consumers, merchants, and reps. Visa is a world leader in digital payments with a mission to connect the world through the most innovative, convenient, reliable, and secure payments network to enable individuals, businesses, and economies to thrive. Jidea is a leading fintech and payment solution provider founded in Saudi Arabia, expanding rapidly across the region with established operations in UAE and Egypt. Jidea's vision is to empower merchants with the tools to start, manage, and grow their business. M2P pioneers next-gen fintech through innovative offerings across payments, lending, and banking landscapes. Their comprehensive tech stack powers end-to-end banking services, BNPL, customized credit cards, prepaid cards, and more. Welcome to this episode of Couchonomics with Arjun. Joining me on the couch is a good friend with whom I've had several conversations similar to the one we're going to have today. Joining me on the couch is Mehdi Fichtali, who is founder and CEO of FinaMaze, right? Which I sometimes do call FinaMaze. Apologies on that. Welcome.
Thank you. Thank you very much, Arjun. Arjun, in the life of a founder, there are several milestones, and one of them is being invited to your Couchonomics.
No, that's very flattering. That's not the case, but I'm happy you're here. So, Mehdi, the way I want to structure this episode today is I think there's 2 or 3 parts to it. I think there is definitely a part around educating the world on the world of wealth management and wealth tech. So please make sure you wear that hat, because I think you come across very well in the way you actually communicate certain things. So I do want to make use of that. Secondly, I definitely want to hear about the wider wealth management, wealth tech sector,
specifically in the region, but also more widely, because your experience is from different places, different markets. And finally, most importantly, I want to hear about where FinaMaze is in its story. Where is it in its journey? Because you're actually on television every second day these days. So thank you for making time. So where I want to start with is a fairly sort of straight and personal question. Your CV says banker, right? Or at least did say banker, yes. Right? You're dabbling in technology, right? How did that come about?
Well, actually, while I was working at Callion, Barclays, and Morgan Stanley, I always wanted to be an entrepreneur within the different desks in which I worked. And I always had this urge. And actually, it happened when the revelation was when one day I wanted to go and I wanted to invest some of my money. So I wanted to meet with my premium or elite banker, and the type of advice that he was giving me was very, very limited, and it was more like a push for the latest sukuk with some leverage or a specific product that they wanted to sell. And I'm sure that a lot of the viewers would have come through the same solution. Whereas at the same time, I know that in these large big banks, I worked with the private banking departments, and I know that they were really going deeper in understanding the clients, in understanding their behavior, understanding what they prefer, and coming back with solutions that are really solving a problem that were really helping them reach their goals. And very soon we realized that actually when you are a type high net worth individual, a type of a $20 million type of investor, the banks will make some fee out of it, let's say 1 or 2%, that's $200K per year, etc., which is worth making some experts spending time on your particular file in order to try to advise you. This could be wealth managers, it could be asset managers. You can sometimes even arrange for specific meetings with some fund managers in order to make discretionary managed portfolios for you. But as soon as you go a little bit lower that bracket, let's say below $1 million, then you are in a very uncomfortable zone where even banks do not know how to deal with you, because even if you go and you invest $1 million, 1% of it is only $10,000. And this is not enough for a bank to be able to dedicate this kind of resources. So how usually banks do it, and this is also to tell you a little bit about the wealth management industry, is that for this mass affluent bracket, what happens is that banks naturally will go for trying to build highways or trying to build standardized products. An image that I often use comes from the fashion industry, and actually it's one of our very good clients who work in this industry who tell it to me, is that in order to be able to sell a shirt to a large number of population, what you do is that you're going to tier this population into small, medium, large, potentially extra large or XXL. And this could potentially work quite okay for most of the clients. If you translate it into the wealth management space, that would be conservative, moderate, aggressive, very aggressive, etc., etc. So you could basically build 4 or 5 portfolios that will be actually funds, which will have different composition inside, that will go from, for the conservative, let's say, it will be 80% fixed income and 20% stock markets, and the other extreme, it will be the other way around, 80-20, and in the middle, you will have something around 60-40, which is quite popular. But in reality, none of these investors will be really having the product that you want. You see, Arjun, I'm not sure that everybody who's watching us today would agree that in order to distinguish between people, 12 astrological signs are enough. Of course, it is not the case. So how come that we accept to have 3 or 4 different type of profiles or different type of portfolios, different type of funds that could satisfy all of us? So this was the beginning of the proto FinaMaze, whereby myself and a lot of people from the industry We really worked for around 2 months just with the pen and paper, saying, how can we solve this solution? How can we, whilst we respect how the constraints that the banks have, whilst we respect how the asset managers and the wealth manager behave today, what will be the minimum changes that we can bring into the game in order to have for every individual the exact portfolio, I would say the exact micro portfolio that will be fully in line with his risk. And because we wanted, as professionals from the industry, myself at the time, I had worked more than 15 years in the financial markets, and Pascal, my chairman, is also an ex-Morgan Stanley Paris. Adia, Georges Lambert, worked for more than 20 years with the Capital Group. Alessandro Chiavarini was my boss actually at Morgan Stanley. After that, he went to UBS. We really thought very, very hard, how can we somehow solve this acute problem? And the answer came from technology.
Mm-hmm.
So we wanted to use technology in order to build for every individual a micro solution, a micro portfolio. It will be fit for him and only for him. And this was the beginning of FinaMaze.
Interesting. So let me ask, there's two questions which come to me, right? So you've brought in a level of sophistication for an audience that did not exist, right? I'm oversimplifying, but you'll have to go with someone with limited knowledge, right? Two parts to that.
Okay, that's okay.
Two parts to that question. Or let's ask the first part of the question. Was there a need in the market that you were resolving, or you believed there was a need in the market that you're solving?
I think there was a need.
Oh, there is a need. Sorry, I should say.
Yeah. I think there is a need because by myself, and I remember on the day I came from the meeting with the banker, and I said to myself, this cannot be what I could be offered given what I had to invest. Of course, I didn't have $20 million to go with a Swiss private bank. So I was frustrated. When I shared it around my friends and who belonged more or less to the same bracket, they by themselves were telling me, listen, we don't know where to invest, so we invest in real estate. And we would prefer to invest somewhere else. We would prefer to have our savings managed better. Sometimes we read on the newspaper something and we want to invest, but we don't know. That's one type of people. And you have those who decided to open a trading account and started to basically play, or I would say invest or play on the different stock markets. And you have dozens of platforms that offer you cheap, very cheap, or even free. I have a problem with saying 0% commission because we all know that nothing is free. So if there is something, these platforms basically probably make money in a less transparent way, right? I mean, it's not a secret for anybody. But they give, and frankly speaking, they give very, very powerful tools to people whose business, whose expertise is not trading. And they give it with sometimes 50 times leverage. And they give them these solutions in a way that will encourage them to trade, because these platforms make money when there is a trade, right? When there is no trade, they don't make much. And what you end up having is people who are not expert using expert tools, and more often than none, they would be losing a large portion of their investments. And what they realize is that this is also something that might not be working for them, because we are human beings, especially when we have not been trained in the financial markets. There are very famous biases such as greed and fear that even structure how the financial markets behave. Just on this point, and just give you or share with you something that you have seen. When the markets go up, when there is a bubble, it goes like this. Mm-hmm. It goes up, sometimes even severely high, but it's constant during several weeks or even months. And when it bursts, bam, it goes down very, very fast. Why is that? Because human beings, when they see something that is falling a lot, they start entering into a panic mode, into a fear mode. And this fear mode is you need to sell at any cost, and it brings down the market very, very fast. Actually, there's a skewness, if I can use this term, when it comes to volatility between when things are doing well and when they blow up. And this kind of biases actually structure the trading platforms, who sometimes do not even hedge the position and just show to the clients his P&L, knowing that sooner or later he will be losing his investments.
I'm going to go and talk a little bit with you about wealth management. I think, and you know, as I said at the start, let's educate me a little bit on this, right? So, and I'm going to come from it from two perspectives. So first, let's take the customer's perspective, right? Wealth management as a concept is far more sophisticated than we as consumers or customers give it credit, right? So I basically split that into, for generalizing, let's split that into three generic segments. The ultra high net worth or the high net worth, who get the private bankers and the sophisticated treatment. So that's great. Let's put them aside, right? Then there is the cohort who believes that they're smart enough, right? And then they get swayed by, you know, this instant high of buying a particular stock today, which goes up 7% tomorrow. And, you know, and so they've largely gone into the world of online trading, which is why we've seen some big numbers come out of, you know, these trading platforms have come up big time. And actually there are in the region here too.
Some people say that these platforms, what they are selling is adrenaline rush.
Yeah, they are. That's why I say you get a huge high, right? And I lived through that high too. On the weekends, you know, sometimes I do go and, you know, again, this is no investment advice.
So if it is on weekend, that means that you are investing in crypto, right?
I was going to say Bitcoin.
Yes.
So I was going to say I do Bitcoin. But then there's this third group of people, right, who just have shied away, right, because they just don't know enough. And those are the people going into real estate. Those are the people who are buying whatever else they're buying, right, gold, right, watches. I have no idea, right? So explain what has the industry failed in doing with regards to educating the customers.
For the banks, for the industry to be able to serve them, they will need to understand them. And they will need to understand beyond just giving them a small, medium, large, or XL size. They should understand them in order to really understand how do they want to behave in this situation or that situation. I'll give you a very simple example that I often use. Let's imagine you, Arjun, you have a twin brother, right? And let's imagine you invest $100 in a given portfolio. And after a few weeks, you do plus 20%, which is quite a decent returns in a few weeks, right? And then I ask you a question. How would you, Arjun, want to behave? Do you want to take your profit, or do you want, on the contrary, to double down? Yeah, so a lot of Arjuns would say, I would like to take profit now. Some others would say, no, I would like to double down. And you have a full spectrum of people who will say, you know what, I will just keep my capital and double down on my profit. Some of them will say, I will just keep half of my capital, etc., etc. So the kind of behavior when people make money differs. And this is something that is not captured into standardized portfolios. Symmetrically, let's imagine invest 100 and after a few weeks you do minus 20%. Bad luck, that's not good, right? What would you do? Here again, you and your twin brother, you will behave differently. You, for example, would say, you know what, let me stop loss now. I rather cut the arm in order to save the body. But your twin brother could say, you know what, prices now are lower. I still believe in a strategy. Let me double down. And in between, you will have a whole array of behaviors. And what the industry is not capable of doing is to try to understand how each individual customer will behave. Why? Because they are customers with the micro sizes. So the only way for the industry to be able to serve them is by aggregating them into standardized funds. And this is where we think the next evolution of the wealth management industry will evolve. People today, particularly the millennials, but not only, given what you've been through, thanks in our phones, in terms of app, we are looking for hyper-personalization in everything. From Facebook to LinkedIn to name it, to even your Uber or Karim app. You want your app to understand you, and you almost want the company to build an app only for you that will really have the buttons that you want in the right way, where you want it, right? And this is something which we can see when we talk with clients, and when clients come to our platform, in our B2C platform, which the first impression is, wow, this is really personalized. I really feel that I understood. And this is something that the industry has missed so far. And we do believe that there is a strong understanding from decision makers in the different banks, particularly in the region here, to move forward and try to do the same business but differently.
Okay, so that stems. Okay, right. So I'm going to come into and talk about FinaMaze a little bit now, right? I'm going to hold on to my other question regarding the overall wealth management. We'll come back to later. So let's talk a bit about FinaMaze. So FinaMaze is giving hyper-personalization or sophistication, which you would typically have only got if you had millions, right, to a very wide array of individuals who don't have millions, right? Who typically would have been categorized into a small, medium, or an extra large shirt, right? How are you guys doing it?
So we tailor make for each individual client his micro portfolio.
But how?
So it starts first by asking them questions, or when it comes to the circumstantial situation, that we combine with their behavior. In other words, we make them enter into a kind of gamified risk assessment, where our machine captures and learns their very unique behavior, their very personal behavior. So in the team, we have a lot of, I would say it in a positive way, nerds, PhDs. Some of them are very much specialized in statistical finance. Some of them, and I'm one of them, also specialized in behavioral finance. To link it back to the old Mehdi, to the student Mehdi, I did my memoir at HEC Paris on the psychology of the financial markets. And I kept what I have written that time, which was largely based on a guy called Richard Thaler, who is a professor in the Chicago Business School, and who in 2017 got the Nobel Prize of Economics, which was a good omen, because this is when the first idea of FinaMaze came up. So what we do is we try to push them into the limits and try to distinguish between Arjun and his twin brother. So we mimicked, if you want, what happens in the private bank with the high net worth individuals, whereby there is first a questionnaire, then there is the wealth manager who we speak with his boss, basically, or the head of the investment committee, who will therefore say, for this type of clients who will go, and we're going to put the US stocks between 20 and 30%, you're going to put 15 and 25% for the European stocks, GC will be between 10 and 20, etc., etc. And the wealth manager, who will be taking care of the clients, will try to find ways how we can be choosing the right weights while respecting the overall direction of the firm. What we want to do is first learn very quickly, in seconds, how the client behaves, how the client is in terms of risk appetite, and we very soon discover that the right figure of different risk profiles should be 8 billion.
8
billion.
Billion.
Because we are 8 billions on the planet, right?
We're all unique, right?
Correct. So of course this is not doable. So we try to reduce it by using some techniques, and we reach the final figure of 4,000. By the way, this 4,000 could be increased to 10 or could be reduced to 100. It depends on the level of the granularity. It doesn't make sense to measure the distance between Dubai and Abu Dhabi in millimeters, although that would be 120 billion millimeter, right? So instead of 120 kilometers. So we find the granularity that is most suitable for this type of clients. And once we do that, we let our algorithms, combined with a little bit of AI, basically build for each single client a micro portfolio with the exact weights that will take into account not only his circumstantial preference, his behavior, but also how the market is behaving, the volatility of the market, the correlation between different securities that will be built inside this portfolio. And of course, we give everything within constraints that are fixed in the marble by the human investment committee. Let me say it differently. We believe that AI is a very powerful tool that should be put between the hands of the humans, between the hands of the human asset manager or the human investment committee or the human CIO or the human portfolio manager, depending on which institution it is used. Why? Because at the end of the day, it's a matter of accountability. Mm-hmm. You do not want, as a bank or as asset manager or as a wealth advisor, to come one day to your client and tell him, listen, your performance was great or was poor because of AI decision. What you want is to justify it. So how this translates in our world and probably in also how we think should be done is using AI for automation in order to accelerate the tailor making of the portfolios is good, provided that it stays within boundaries that are fixed by the investment committee, that's fixed by human beings. And the human beings, when we ask him to input his parameters into the system, we tell him, listen, you should be able to defend in front of any clients. You should hold yourself accountable in front of any clients for any weight that the AI could choose within these boundaries. And since this is very well understood and it corresponds also on how they work in the private banking world or in the wealth management system, where you will have the investment committee deciding templates and every portfolio manager will be working within these templates in order to build the right discretionary managed portfolio for that individual client. So by having this and by mimicking it with the AI, we have somehow reached the level where in few seconds you can get your tailor-made portfolio.
Okay, and just very quickly, how does the rebalancing happen then?
So the rebalancing by construction should happen with two different levels. Either because the portfolio manager decides to, you know what, I'm no more comfortable with the S&P 500, what you have, the example that you took earlier, and I want to reduce it from 20-30% to 5-15%, or I want to increase the rates, or I want to increase oil, etc., and I will change the whole brackets. And by a click of a button, all of the clients who were invested into these templates will have all the micro portfolios that are unique, rebalanced in order to fit again with the same new template. That's on the one hand. On the other hand, it could be some very personal rebalancing whereby your portfolio went up and you are achieving your goals, you are reaching the goals that you have mentioned, your monthly contribution are good enough. So the idea here is to secure the profit that you have made. If you go to the example we took earlier, it should take profit. You, but only you, not your neighbor. So the rebalancing here happens and will rebalance the unique micro portfolio of Arjun in order to fit again with his risk profile and his risk appetite. So you have these both scenarios. So you have the markets on the one hand, the volatility of the markets. You will have what the investment committee decides, and you will have what each individual client prefers. And it's the combination of these three, thanks to technology, thanks to AI, that allows for a very smooth, personalized investment.
Okay, so Mehdi, I've got loads of questions running through my head, but let me start with one. So my understanding with FinaMaze is that you have a B2C proposition and you also have a B2B proposition, correct? Yes. With all the will in the world, your product is very sophisticated, right? In terms of understanding the value of what you're bringing. Okay, so it's great that you've given such a good explanation, and hopefully this episode will go to whatever 20, 30, 40,000 people, and they'll all be a bit smarter for your contribution. But for an average person, this is way more sophisticated than, let's say, the way an online trading platform is, which gives you a high, or even some of the robo advisory plays, which are very much if I may say they're the broad brush sort of approaches. That's the B2B side, right? I've got two questions. One is, what is your B2B model? right? And if your B2B model relies on leveraging the private bankers or the advisors that the banks or whichever financial institution you work with, how are you bringing them up to this level of sophistication of thinking that they can actually go and communicate what you've just done sophisticatedly enough to people who are on the other side? Because there'll be lots of people who might have money, but might not have as much an acumen. So sorry, I've asked you 3 questions. They're very long, but I think that just gives you a chance to kind of go on for the next 5 to 10 minutes.
Yeah,
go
sure.
ahead.
Well, listen, we do not believe that all the clients should necessarily understand exactly what is happening for their portfolio. And the same way, none of us believe that we should know about an illness as well as a doctor and to understand exactly what's inside the pill that the doctor prescribed that will heal us. In reality, we believe that in this world, particularly in these sophisticated matters, in the financial world, that there is a premium for the experts, and most of the people I've spoken with, I'm talking here about these mass affluent, would say, you know what, I just want to understand the high level, but in reality, I will ask you the question only once and then you run with it. So you are completely right. Our solution, or any good solution in that aspect, should understand the level of sophistication of their clients, and should then offer services or offerings or products or investments that are in line with each client categorization. And you know who imposed this on us? The regulator. The regulator's role is to protect the retail, people whose wealth is below a certain threshold or are not experienced enough, and to let what they call the professional people, those who have got wealth above a certain level of threshold, basically have access to more products, which seems quite natural. But you know what? It is frightening to see that some of these very sophisticated trading platforms with a lot of blows and whistles everywhere could be available for people who are going to invest their only 500 savings, 1,000 savings. And sometimes it's even sad to see some people who are lacking the financial education be, as you correctly said, gambling without understanding the dynamics behind them, and they end up losing substantial amount of money given their wealth. So the idea here is to offer not one solution, but to offer multiple solutions. In other words, we believe that, like for martial arts, some people are white belt, some people are green belt, some are brown belt, some people are black belt. So what you want is to determine very early on what level of sophistication the individual investor that you are welcoming the platform is. So as you offer him what is good for him, where he will not feel lost, and when he will not feel enticed to do more than what he should. So this is to answer your first question. Mm-hmm. And by asking the onboarding questions, you can very easily direct the client into one category or the other, or anything in between. And these different categories could be configured with in a smart system. So that's to answer your first question. Now, as for your second question, let me come back a little bit to the genesis of FinaMaze. So back then, we wanted to create something that will be enabling us to basically build something that will allow clients to have personalized investments being taken care of. And we scouted the market, as any founder would do, to understand what kind of solutions are there. And in reality, we're quite frustrated with the offering that was there. Of course, you had some very big, beautiful names in the US or in Europe that were empowering this type of, I would say, robo-advisors. And they didn't suit us.
Yeah, but then tell me something, right? So I'm sorry to just cut you off right there. So how are you different? And so what are you doing different to the robo-advisors which are in the local market here or anywhere else?
Yeah, if you want, most of the robo-advisors here in the region and elsewhere are using a tech stack that already has been developed elsewhere, and that may or may not be added to the region, but they are using that existing software out of the shelf, and they are trying quite cleverly sometimes, and with a certain success for a couple of names that I have in mind, acquiring clients. But in reality, by doing so, what they are doing is marketing this solution to the local market. And this is not the case only of the fintechs. It can even be considered for a larger.
So let me go a little bit deeper. So in your conclusion or in your view, did Robo Advisory over the last decade, because they've been around and there's some very big names, and a number of them were acquired actually by the bigger players, were they able to live up to the potential they promised?
In reality, no. But I would say it's not because they did anything wrong. It's because the average client would rather lose money with a global multinational bank that he knows rather than entrust his wealth or his savings with a very clever and smart, regulated, fully capitalized, audited, secured name who is just new in the game. Let me say differently. A lot of people who are even our clients, they tell us, you know what? My main savings are with this very big American bank or this very big local bank. And with you, I love you. You are so smart. Actually, my best performing portfolio is with you. But I will never put more than the change of my wealth with a fintech.
But then, Mehdi, doesn't that beg the question, why will your B2C offering succeed?
I do believe that the B2C success in this wealth industry, it's more a marketing play. And those who succeed were very cleverly managing to acquire a lot of clients in a very short period of time. But wait, that was what the world wanted until 2022. At that time, VCs were saying to most of the fintechs, what we care about is not how much money you burn. What we care about is how much grow you show month on month. So if you need to spend that much on marketing, please do. What we want is to be able to put a valuation on you depending on the number of your customers. But 2022 came. And then what we realized is that does not make sense to acquire a client for a cost which is equivalent of 1, 2, sometimes even 3 years of revenues. And this is where the VCs turned into profitability. You will need to show a very profitable business plan. And from when it comes to since you're asking us the question, we don't believe that we are the best marketer in town. And frankly speaking, it's a game that is somehow makes the LinkedIn, Facebook, Instagram, TikTok, etc. rich by transferring the wealth of the shareholders, of the VC, of the investors into their pocket while enjoying some customers that could be acquired in the meantime and not necessarily very profitable. And also what we realize is that, wait a second, we are bankers by profession. We are asset managers. We are PhDs in quantitative finance. What we are really bringing to the industry is not our capability of acquiring swiftly and cleverly clients across different social media channels. What we are bringing to the industry is the solution for which we worked very, very hard, that we have fine-tuned, that is built by an army of dedicated engineers and who spent several years in order to learn from client feedback, from our B2C feedbacks, in order to build a software that's today capable of empowering, to be implemented in large banks.
So let me understand this. So B2C for you then is, it's just
a showroom.
I was going to use the word, I was going to be a bit harsher with you and say it's a hobby where you actually learn and then you deploy towards your B2B business.
That is correct.
So the real game in town is the B2B proposition.
I do believe so. I believe this is what VCs and shareholders want. I believe...
I think infrastructure is maybe better. I think, where fintechs lack in this part of the world is most of them are B2C plays. Most of them are marketing machines. I've come across several wealth tech players who are nothing else but a very shiny layer on the top. And actually, there's nothing in between because they're leveraging third-party platforms, custody platforms, trading platforms, brokerage platforms. And in effect, they're just a shiny layer and a messaging system, which, to be honest with you, what are you buying? Right? So let's talk a little bit about B2B. But before we talk about B2B, tell me the state of wealth management from the context of the banks, and why do you believe they will go with you?
So banks today have got a problem, which is how they can cater to the mass affluent without being perceived as a product pusher, but as a solution providers, to be advisor at scale. And they are facing three levels of problems that they want to be solved and for which there is no easy solution. And I do believe that the solution will come from fintechs. I'll tell you why. Let's go back to our B2C and to our, if you want, showroom. All these guys that they were telling us, we love your products, we love your goal-based products, but you know what? We want to invest in private equity. And in the private equity world, the minimum ticket size to invest is $500,000. So who would invest $500,000, $1 million in a single private equity name or in a single VC? I can give you the answer. Somebody who owns $20 million. It does not make sense if your net wealth is 5 to put 20% on one single name, which will capture your money for at least 10 years with a certain level of risk, right? So we worked very, very hard to see how we can bring this typology of products to the masses. And we worked on it with our regulator, with Abu Dhabi Global Markets. And we were the first fintech here that offered investment in private equity from a size starting at $10,000. And by doing so, and when we launched it, we received a lot of phone calls from clients who invested $10, $20, $30, $57,000, $113 and $436 in this product. One of them called me almost with tears in his eyes. He told me, I worked all my life in private equity, and I was never able to buy one stake. Thanks to you, you have given me the opportunity to invest. So thank you very much for that. This is a lesson learned. And there was no product out of the shell that will allow you to do it. So we built it. We did it for the private equity. We did it for generally other funds that aren't necessarily private equity. We did it for crypto. We even did it for contrarian portfolios. Some investors came to us and told us, we think that the S&P 500 is too high. How can we invest against the S&P 500? So we built a solution for that. Crypto, you by yourself trade in crypto, so you buy the Bitcoin. But how easy is it for you today to invest in Bitcoin and short Ethereum? We built a portfolio that goes long and short into those two cryptocurrencies. Inflation, one of our best product until last month because inflation went down. So this product invests in one single button of investments into an array of securities that behave well and give you good profits if the inflation materializes. So these kind of lessons, we learned them by being close to our B2C in our laboratory, in our showroom, if you want, and we made our product become stronger. And this is when consulting firm called us one day and said, we like what you do, can you white label it? To which our answer was, wait a second, we build the software for our own use case? Yeah, sure. let's do it on a white label basis. And we were invited to RFPs with very big names. And we were quite impressed by those names. And you know what? We won a couple of RFPs, and we are still working with other banks on a one-to-one or participating in other RFPs. And the reason is because we built an IP, because we built a software, because we built with our own hands a solution that caters to what the end client wants. If you want to sell a product to banks, you better be knowing what the clients of those banks want and what's better than having by yourself an exposure into that space, a direct exposure. And indeed, one of the reasons that allowed us to go that fast and that high and to the last rounds with these different RFPs, it's because the banks were by themselves telling us, you know what, guys, all the people we speak with are only IT vendors. You're the only one who has got a functioning B2C laboratory. Banks are like motherships. They are big and huge, and they cannot go and explore every single corner of, let's say, this island. So what they need is jet skis, and fintechs are those jet skis. Fintechs are the jet skis that allow technology go and explore and fail and try again and listen to and pivot if required in order to basically go and find the perfect beach, right? But some of these jet skis will run out of gas, run out of funds. And so the whole idea is for those fintechs, particularly those who are trying to solve problems that the bank are having, is to very quickly develop an R&D internally that the banks may or may not be willing or capable of building in the same in the short term. And once they have built this solution and tested it in real life with a laboratory, with a showroom, then have the trust in order to go in front of these banks and tell them, listen, guys, we know how we can help you solve your problems.
Mehdi, that's interesting. Well, I wish you the very best. We're out of time. I think I think I like this analogy of having the laboratory where you learn from the laboratory and you apply to the B2B business. It's very good to hear that you won a couple of RFPs, so you will be going live with a couple of banks. Best of luck with the fact that some of those banks are able to actually take the product to the market. I think that's a question mark. I think time will tell. I think banks have had a funny relationship with what they deem as wealth management, as you said, for the mass affluent and the mass market. But I do think more and more of these banks are realizing that there is a value to be played out there.
Yeah, on this point, I think that the banks have no choice. Let us go back in 2005. No banks had an app. And basically, at that time, if you wanted to make a wire, you should either go to the website or sometimes even go to the branch and wait a bit and make the form, sign it physically, etc. And at that time, a relationship manager, a bank teller, can only manage a certain number of clients, call it a couple of hundreds. Why? Because all of these clients will come in to see him on a day basis, and he's got only 8 hours per day. So this was the maximum number of clients that the bank teller can do. Now that the first bank came up with an app, all the other banks followed because they're saying, you know what? Our own one single bank teller can today manage not 200, not 400, but a couple of thousands, if not more, of clients. And you know what? Those branches, let's close them down. So the branch became on your phone. Now, when it comes to wealth management and how we positively and optimistically look at it, is that for banks, having an investment app, not a robo-advisor, but a holistic wealth advisory app that will be able to offer to clients anything from goal-based investments to discretionary managed portfolios on a particular theme, to private equity, to structured notes, to so on and so on. It will replace somehow the elite or the premium relationship managers by empowering him to manage not 20 or 40 mass affluent clients, but 400
Yep. Got it.
or even 1,000.
No, it's an interesting evolution. I think we're going to all wait and watch and see how it evolves. I do agree with you that the traveler direction is exactly as you defined it. I want to thank you for coming in.
If I can just add one last
Go
thing,
ahead.
I'm sure that you're going to like it. By having this technology of wealth management built and available and personalizable, some other non-financial players became interested.
Yeah, I'm sure they will. I'm sure. And
Telecom,
Yep.
but also all those players who wants to build super apps.
yep.
And those players do not need anymore to recruit dozens of private bankers and have a full back office and a full middle office, because now today this technology allows them to automate all these processes. And by doing so, they will be able to enter into this market as some telecom companies did in the payment space, for
Yep.
example.
Yeah.
The next evolution is definitely investments. And you know what? Expect a lot of dynamism, a lot of ways that will be hitting the wealth management industry, not only in the region, but everywhere.
Everywhere else. No. So your enthusiasm is palpable. You do believe in what you do, which is actually a very good characteristics of any founder. I do wish you the very best. Obviously, we'll stay in touch and we'll keep talking. But thank you for coming in this sort of late Friday evening, and have a good weekend.
Thank you so much, Arjun, and see you soon.
Right. So that was Mehdi. As you can see, Mehdi is the flag bearer for everything wealth management in the region and beyond. His company is called FinaMaze. Keep a lookout on them. He's got a B2C showroom, as he says, but more importantly, he's focused on the B2B side. So you might be using his platform, I guess, in the near future, might not know that you're actually using his platform. But with that, goodbye till the next episode.